We'll go ahead and get started. Hi, everyone, and welcome to the first Rough Cut seminar of 2022. Next week, we have an open spot available for you, your colleagues, and your students to present at next week's Rough Cut. So please contact me for more information if you have a good candidate for that. Today, I'm pleased to introduce Dr. Justin Gallagher, who will speak on community banks and local economic recovery following natural disasters. Dr. Gallagher is an assistant professor of economics at Montana State. His primary research field is environmental economics with a broad interest in household finance, labor economics, and public economics. As a reminder, this event is being recorded. We encourage you to keep your cameras and microphones off during the presentation and to join in for questions and answers when the speaker has finished. With that being said, I will let you take it away, Justin.
All right, thanks so much, Paige. As Paige said, I'm an assistant professor here at Montana State in the Department of Agricultural Economics and Economics. Just to add another note to to the introduction, overall, most of my research focuses on environmental risk, including studies on how individuals perceive environmental risk and make decisions, the financial consequences of negative events, such as natural disasters, and how state and federal governments can enact policies to better manage these risks. The project I'm going to talk about today sort of falls into that research area or my research agenda. The title of the project is Community Banks and Local Economic Recovery Following a Natural Disaster. This is ongoing work, so I'm grateful to have the opportunity to present here. Happy to get questions and feedback at the conclusion of the talk. The project is joint work with a colleague of mine or a somewhat frequent co-author, Dan Hartley, who's a research economist at the Federal Reserve Bank of Chicago. So just to kind of give a bit of background and to motivate what we're looking at. One way to motivate it is from the perspective of the types of banking institutions that are available in different regions, in particular community banks. So faster economic growth and improved economic stability were prominent arguments for US banking deregulation in the 1980s and 1990s. What might be surprising to many of you in the audience is that before roughly 1980, the United States really had all these different pockets, these banking pockets, where a bank that was chartered in Montana, for example, was not able to operate in Wyoming. It was state by state sort of banking economies. And even within a state, banks had restrictions on which areas of the state that they could operate in. So there's a lot of restrictions in place. What this led to were banks to generally be much smaller in size than what we're accustomed to today with like Wells Fargo and Chase and the like. And these banks were, as a consequence of being smaller and kind of really focused on particular areas, they could be more vulnerable to economic shocks to that area. So the hope was that with this deregulation that was rolled out, that'll explain sort of state by state over about 15 years, that the banks, when they have lending and sort of customers in different states, that these banks would be more resilient to shocks or economic downturns that might occur in one area of their business region, and be better able to manage those events and still provide credit to credit-worthy customers when there's economic downturns or in what I'm going to look at, natural disasters. One consequence of this deregulation is that we went from many smaller banks to fewer larger banks, which I'll call kind of non-local or interstate banks, and a decrease in the number of local banks or community banks. Community banks are banks that are traditionally very focused on the local economy, the local community, often have more close relationships with their customers. So it's not as much about just a credit score, say, but really kind of knowing the history of lending to that individual or that family or that business. And because of that, economic theory suggests that these community banks might have a greater incentive to lend to individuals or businesses in their region or in a particular economy. Local economy, including when there's an economic downturn or something devastating happens to that area, such as destruction from a natural disaster. So this kind of previews this tension that I'm going to talk about and try to investigate, which is on one hand, larger banks, these interstate banks, can have more capacity to lend. On the other hand, these banks might not want to lend to sort of local areas that are in hard times, because there'll be more profitable opportunities to sort of spend their resources and lend in other states or other regions. We got interested in this project from a stylized fact that we sort of stumbled upon in an earlier project. So this is a stylized fact from a paper that Dan and I published in 2017 that was solely focused on New Orleans. We were looking at Hurricane Katrina and the effect of Hurricane Katrina on household finance, that is on how sort of the financial balance sheets of individuals in living in New Orleans at the time of Katrina fared following the hurricane. And as part of that, we looked at lending and mortgage balances, mortgage loans, whether they had a house, and the amount of debt that they had. And we came across kind of a puzzling fact, which I'm showing again here in this slide. So I'm going to try to talk through this. This is great motivation for what we're going to do today. So what we see in this picture, in this figure, are two trend lines that are quarterly, that cover a time period 3 years before Hurricane Katrina hit New Orleans, which is measured by the dashed vertical line, and 3 years after Hurricane Katrina hit New Orleans. It includes almost every single home loan made to anybody living in New Orleans during this time period using a really nice publicly accessible database called the Home Mortgage Disclosure Act, or HMDA data. So we really see every single mortgage that's made. And as part of those that lending database, there's IDs for the lenders, so we can track the lending activity by different lenders over time and over space. That is, do they change their lending activity each year or each quarter in this case? And do they lend more in New Orleans versus outside of New Orleans? And using that information, we can define or kind of break the lenders that are active in New Orleans into two groups that we call local and non-local. So the non-local lenders, those are the red circles. Those are the ones that have an above, sort of have the majority of their lending is outside of New Orleans. And the blue ones, the hash marked blue line, are lenders where they're more focused on New Orleans. We split the data at the median, so we have those that are more focused on New Orleans versus those that have a wider scope. And what we see is, leading up to the hurricane, about 2/3 of the loans were from these non-local, these more national type lenders. They had 2/3 of the market share. They were kind of the primary provider of credit to New Orleans, to individual homeowners in New Orleans, the red circles. And then afterwards, right away, there was almost no lending activity. Some of you may remember the devastation, and New Orleans is underwater, and kind of the whole economy shut down. But then within a couple of years, the local lenders, the blue line, recover, and they're back to doing kind of business as normal, the same amount of loans. But these national lenders, the ones that should be more geographically capable to lend, that is, they're not, their business isn't hurt as much by this event, so they're more stable economically. They have resources from other areas of the country that they could use to pull in and make new loans. For the most part, those lenders stopped lending or dramatically reduced their lending to New Orleans. So this got us thinking about, the potential consequence of the banking industry, that is the makeup of the banking institutions at the time of a bad event, a natural disaster, that this makeup could have an effect on the recovery of the region following the disaster. If there's fewer loans going to New Orleans because most of the lending was done by national lenders, this could really drag or slow down economic recovery collectively, but also hurt sort of individual economic recovery at the person level. So just to kind of bring it a little bit to Montana, move away from New Orleans. So local lenders may be particularly important for communities in states like Montana. So overall, only 46% of US adults could afford an unexpected $400 expense without borrowing or selling an asset. So nearly half of adults couldn't really manage a fairly modest unexpected output of $400. And overall, just 55% of households do not have enough savings to cover a month of lost income. Residents in rural counties, we know, have lower wages and face higher unemployment on average than those in urban counties. So access to bank credit might be particularly important for natural disaster victims in these rural communities. So why focus on natural disasters? So this is one of the reasons why I'm presenting in this format, because it's sort of pulling together this financially motivated, direction, but also tying it in with the natural environment, in this case, natural disasters. So natural disasters are random, costly, and widespread shocks to the local economy. They're frequent. The US experienced $400 billion in damage from just the 14 most costly disasters in 2019. The type of disaster that I'm going to look at, the data that I have, are state level disasters. So disasters declared at the state level. For example, if there were fires or drought in Montana, that could lead to a disaster declaration for Montana in a particular year. Furthermore, the economic cost of natural disasters is likely to increase in coming decades. That's for a couple of reasons: climate change, as well as just where people are living at these sort of urban, rural interfaces where there's wildfires, living on the coast where there's lots of floods. So we think that these are going to become more disruptive and more kind of important to understand and manage going forward. Here's a picture just to give you a sense of where natural disasters occur, at least the type that I'm tracking. And the punchline here is that they are occurring everywhere. So there's two figures here. The top one, they're both in the United States. The little lines there you'll probably recognize as the counties. So it's a county level map of the United States. And I'm kind of plotting here disasters that are these state level disasters, but only focusing in on even a subset of those state level disasters, the subset that exceed the 75th percentile cost threshold. So kind of looking at the right tail of this group of the worst disasters. And if just looking at that right tail over the past few decades, we can see in the top picture that nearly every county in the United States, with the exception of kind of Nevada area, had at least one of these disasters. And many had more than one. That's what the bottom picture shows. So it's not something that's specific to Florida or California, which might get a lot of attention in the news, but it really is widespread throughout the country. So moving to this particular research project and what we hope to do here. So we have two questions we want to look at. First, do locations with a higher share of local banking at a time of a natural disaster have greater total lending post-disaster? So the study, the figure from the Gallagher and Hartley study was the Hurricane Katrina one we just looked at. There's another prominent study by Cortez and Strahan, which suggests that in fact these interstate lenders are an asset to a local economy, that they do end up lending more overall. They look at a larger group of events and not just Hurricane Katrina. So there's a bit of a tension here as far as what the current literature says, but in both cases, there's fairly smaller groups of events. So one of the things we want to do is have a much larger set of natural disasters that cover a larger geographic area, and not just look at kind of does the local lending increase or the non-local lending increase, but the total amount of credit to that area. Because what previous research suggests is that one of the key ways to manage kind of the destruction and the rebuilding from these natural disasters, both for individuals and for communities, is by borrowing. And so you need lenders willing to lend. And so the amount of credit, the total amount of lending or the total amount of credit could be a key factor in the recovery of a region. So we want to investigate that. And then we think that total level of credit could be kind of the causal channel or the mechanism that could lead to differences in sort of the trajectories of the economies, the local economies following a disaster. That's question 2. Do any differences in post-disaster lending at the time of a disaster, attributable to the role of local banks, affect regional economic recovery and redevelopment? And for this question, we're not aware of any existing research on our second question. The first question, there is some research that doesn't exactly get at what we're hoping to look at, but kind of gets at it from a different angle. But for question 2, we're not aware of any previous research. So We have maybe another 20 to 30 minutes or so. I'm going to quickly try to cover the following. So as a project overview. So economic theory provides contradictory predictions on how the concentration of lending by community banks affect lending to a disaster region. We build a new data set to test the two hypotheses that I just outlined. We then estimate a statistical model. It's an event study model, and I'll get more into that in a moment, but it allows for a causal interpretation of the concentration of community banking at the time of a bad event, natural disaster, on the two outcomes that we're most interested in. So the total amount of lending in that area and the trajectory of the economic recovery. Fourth, some preliminary findings. So our preliminary findings are that counties with higher concentrations of local banking at the time of a natural disaster have first, greater total post-disaster lending. And second, this post-disaster lending, we argue, helps translate into what we're observing as a somewhat faster economic recovery following the disaster as measured by local wages. And then we think, at least our preliminary results, suggest the importance of public policies that encourage and support the role of community banks, especially in more rural areas, such as Montana, where community banks have traditionally played a larger role. Let's see. So I think in the interest of time, I'm just going to kind of skip over a little bit of the theoretical background and try to summarize it with this slide. So I will say and sort of be totally upfront that sort of our theoretical, I guess, framework or theoretical model is built on some key contributions by theorists in economics previously. And we're not trying to do a whole lot of new theoretical work, but we're trying to just to build off of what's already been done and applying it to our framework. So we focus on counties with different concentrations of what we're going to call local banking activity at the time of a natural disaster. We then use natural disasters as a potential shock to both bank capital, that is sort of the resources the bank has to potentially lend, and borrower capital, which would correspond to both the need of us, of borrowers, but also whether borrowers might be more creditworthy. That is, do they have collateral, such as their home, that would make them more able to receive a home loan. There's two predictions that I already previewed on the first slide, and they go in different directions. That is, our understanding or our framework doesn't give a clear answer as to what's going to be better for a local economy, to have more local banks or to have more interstate national banks. And we divide these predictions into what we're calling capacity and incentive. So the first one, capacity, local banks have less capacity to lend to a disaster impacted region. The reason is they're less geographically diversified. If a disaster hits their area, the people that they lent to, whether they're homeowners, businesses, farmers, they're likely going to have a harder time paying back those loans, or they might have to delay paying back the loans. So there'll be less income coming into these banks. The banks themselves might have their infrastructure destroyed, so there'd be less able to lend. They have less capacity. At the same time, local banks, by the virtue of operating really focused and intensely in a particular area, are very invested in that community, that area. It's often the case they may have lent to sort of generations of families, really have a good understanding of the local economy and sort of the businesses and sort of the different considerations in the local economy. So these more local or community banks might have a greater incentive to lend, even if they have less available credit to lend. And then so on balance, we're not sure if total lending is going to go up or down. It could go either way, depending on kind of how this plays out. That's why we want to sort of bring it to the data and try to test it. So we had a fairly ambitious data collection effort. We combine primary source data from several different sources into an annual county level panel data set. So our panel data set spans 1981 to 2014 in the entire continental United States. So The first source of data are the natural disaster incidence and cost data. These are from FEMA. We're using presidential disaster declarations. Some of you may be familiar with these. These are disaster declarations that are made state by state. And when they occur, they specify the counties in the state that are subject to the disaster, that is, have sort of verifiable damage or destruction, or sort of just generally bad events, bad consequences of the disaster that occurred. So we can use that information and not only look at the state, but actually bring it down to the county level. We have this for about 1,000 different natural disasters over this time period. And then as far as the cost of the natural disasters, we're already kind of limiting ourselves to these very large events. But it might also be, based on previous literature, even within that larger set of natural disasters, it's really like the very more expensive ones, kind of the right tail ones, which typically have the largest impact on the local economies and on individuals. So we want a way to sort of even divide further, and we can use dollars that were distributed as part of the Presidential Disaster Declaration to repair public infrastructure that's under the Public Assistance Program as a sort of a consistent measure of disaster size and cost, to kind of rank within this group of presidential disaster declarations which ones are more severe and which ones are less. And we can kind of look at different cuts of the data. We have information on bank deposits. This is how we're going to kind of create our measure of whether a particular county, in this case, has a higher concentration of community banks or a higher concentration of interstate or non-local banks. We're going to create a continuous measure that goes between 0 and 1 that indexes the kind of the percent or the amount of local lending or local banking activity that's happening in that county using FDIC deposit information. So that is dollars of deposits. Banks have to report where individuals that are banking at that institution, where they live, as far as putting checking account dollars or savings account dollars into the bank, so deposits. And that's how most banks traditionally raise the revenue or the capital that they use to then make loans. Third, we have information on bank loans, again from HMDA. I'm not going to focus on that too much in today's talk, but we can use that to sort of answer the first question today. I'll be mostly focusing on the second question. Fourth, we're going to really take advantage of this rollout of the state banking deregulation that I'll describe in a moment as a means to solve some empirical or statistical challenges, which is to really isolate this channel that we hope to identify, which is how the concentration of local versus non-local banks affect lending in the area. And then fifth, our outcome information on the local economy. We're focusing on 3 main measures or proxies of economic, conditions in the economy at the county level. First are wages, changes in wages, population, and then property values. They come from 3 different sources, and I'll just note that the property value information is still, we're still constructing that, but it's a repeat sales index that's sort of the gold standard as far as what we want to get for property values. Let me describe how we define or index what we're going to call a county local banking index. So we use the FDIC bank deposits, as I mentioned, to define what we're calling a lender localness score for each lender L and each county C for each year T. So just to be clear, this lender-based measure can vary between lenders, vary between counties, and vary over time. So then once we calculate that for each lender, we then calculate a county level local banking index by taking a weighted average of the lender localness scores for each lender operating in the county during the year. This it's basically a weighted average. We're going to have kind of an index that ranges from 0 to 1. The closer to 1 the county is on this lender index, that means it has a more larger intensity of the lending happening from local lenders. If you're close to 0, it's a larger intensity of the lending happening from these interstate or non-local lenders. And that's what we're going to kind of use as one of our key independent variables to try to understand what happens or how economies evolve after a natural disaster. Here's just a picture to give you a sense of the numbers and kind of how that looks at a moment in time. This is, again, a picture of the US county level from 1995. And what we're plotting here is the county local banking index grouped into 3 intervals, terciles, first, second, and third terciles. So the whitish counties are the ones in the first tercile. These are the ones that would have the highest concentration of local lenders. The orange ones are in the middle, and then, I misspoke. The white ones have the highest concentration of interstate or non-local lenders. They have lower scores, they're close to 0. On the other hand, the red counties are the third tercile bank index. So those are the ones that are closer to 1, and they would have a higher concentration of local lenders. In our study, we're going to use the continuous variation, but it's helpful for pictures just to get a sense by grouping it together. A couple things you can see. I haven't described kind of the rollout and what we're going to be leveraging for these indices yet, but if you look at it and you kind of know where the state boundaries are, you can see there's there's a pretty clear within-state correlation between counties. That is, if you're in Arizona or Texas, for example, you tend to have a higher concentration of interstate lenders. If you're in a place like California or Nevada, you have a higher concentration of first tercile bank index. So that is the local lender. Sorry, I just mixed it up again. So if you're towards the first tercile, it's going to be interstate. And if you're in the third tercile, if you're close to 1, it's going to be a high concentration of local lenders. So the statistical model, let's see, I guess we have about 10 to 15 minutes. So I'll try to go through this in some detail, but might miss out on some of like the particulars. We can talk about that in the Q&A if that's something that interests you. But what we want to do as a statistical model is have a model that we can look at the dynamics of what occurs after the event, the natural disaster. So not just sort of get one estimate at a point in time, but look at it across time. Event study models are very good at doing this because that's exactly what they allow to do. We also want a model that allows us to have what we're going to call a heterogeneous treatment effect. Here, the heterogeneity or the difference in the treatment effect is going to be based on a pre-treatment characteristic. So it's going to be based on something that was unique to that county before the disaster occurred. And in this case, what's going to be unique to that county is this local banking index. So the local banking index right here in the first term. So the way that this works is our outcome is, for at least for today, is going to be an economic outcome. We're going to focus on log wages for county C in year T. The coefficient that we're estimating, the one that we're interested in learning about, is this delta. So the very first one here, the delta tau. Delta tau measures the impact a large natural disaster based on the of a large natural disaster based on the composition of local banking in the county in the year before the large disaster. And if you look closely, what we have is this is going to be an indicator variable here, whether or not that county at that time period had a large natural disaster. And it's going to be interacted or multiplied by this local banking index in the year before the disaster. So this local banking index is fixed in the year before the disaster because we want to kind of freeze it at a moment in time, take a snapshot of what the sort of banking institutions looked like at that moment in time just before something bad happened to that area, and then kind of bring it out over a series of periods after that moment in time to see how the economy evolved. Now we're going to control for smaller disasters, the ones that are kind of below the threshold that we're looking at. We also allow for the model controls for fixed county characteristics, such as your geographic location. This could matter if you're close to a large city or close to a port, for example. And it controls for sort of variation in this case, say wages that could happen state by year. So if there's kind of local recessions, or maybe like a very large employer closes down in a state, or a very large employer comes to a state, this could affect wages in that state in that year. And so we're allowing that to occur, and we're kind of controlling for that type of event. Finally, the model is flexible in that we can sort of allow for some of the concerns in the sort of statistical aspect, the precision of our estimates. More specifically, we account for spatial correlation and autocorrelation. So what I just described was our baseline model. Our baseline model uses a natural disaster and defines one as exceeding the 90th cost among those presidential disaster declarations. So we're really trying to focus in on the kind of the largest of the largest. For today's talk, due to some statistical concerns that we're still working out and kind of trying to get a very clean baseline understanding, we're not using all of the natural disasters that we have sort of in our data set. We're just limiting it to a panel to counties with one large natural disaster during this time period. And as you'll see in a minute, we're limiting the time period to 1981 to 2000. So we're really kind of throwing out or not taking advantage of a lot of the data that we spent a lot of time collecting to try to kind of get a panel and a set of counties that we feel confident in the answer, and then kind of build out from there. The last modeling concern that I want to mention before looking at some results is the following. So some of you may have already flagged this and have this in the back of your head, which is local bank development is not random. It's endogenous to many factors of the local economy or the county, including the size and the wealth of the local population, among other things. At the same time, these locations with a larger or wealthier population might be more able to cope with the negative impact of a natural disaster. So these two things together mean that unless we account for the geographic endogeneity of the banking institutions, that is sort of how they developed and why a particular area might have more or less local banking, then the model will likely lead to biased estimates for how the concentration of local banking impacts economic recovery. We think we have a solution to this. Let me explain our solution. So here's where we're going to bring in kind of this state-by-state deregulation that I already previewed. So prior to 1978, every state prohibited banks from other states, and most prohibited branching to other counties in the same state. And then there was kind of two different types of deregulation. The first is interstate. So beginning with my home state of Maine, in 1978, states passed what was called a reciprocity law that allowed banks that were operating in Maine, for example, to operate in another state, say New Hampshire, if New Hampshire also signed on to this law. So there's kind of this banks from New Hampshire can open up branches in Maine if banks from Maine can therefore open up branches in New Hampshire. So kind of both states would open up their borders to this cross-state banking. And so it evolved this way from 1978 to 1978 to 1994. So each year, like more and more states kind of joined on. So it slowly went from these isolated state banking systems to a more national banking system. At the same time, states passed laws to open up sort of banking, unrestricted banking within their state boundaries. So it wouldn't be the case that, for example, like a bank in Gallatin County might have had restrictions of opening up a branch elsewhere in Montana, but with intrastate deregulation, a Gallatin County bank could then operate anywhere in Montana. Here's just kind of a plot of the timing of these laws. The key thing to take away here is it wasn't just all at once. And so for our purposes, that's nice. We had some opening up or some deregulation throughout all of the 1980s and into the mid 1990s. So we have this nice 15-year period where there is this kind of state by state opening up, and this is this is going to allow for changes in sort of the banking composition in each county that we want to leverage. A key point here that's going to be really important for us to be able to leverage this law is that the timing of these state level banking deregulation laws is not correlated with something to do with the economy in that state or something to do with the existing banking institutions or anything like that in the state. And this kind of key assumption has been shown in other work by other researchers that have looked at this deregulation. So, so we feel pretty good about going forward and thinking of this as sort of an exogenous measure that we can use and leverage to kind of help us in our study. Let me try to put what I was just saying into a picture to help to provide a little more intuition for why this might make sense. So here's an example. We're looking at two states. We picked these states because in 1982, up here in the upper left-hand corner, they had almost the same mean county local banking index. It was very close to 1. This was before there was any intrastate or intrastate deregulation, so it was all like very local banking. And then we're going to look at this time period, 1982 to 2000. We mark 4 different years as key years. These are years when there was some type of deregulation in one of the states, either interstate deregulation marked by the solid lines or intrastate deregulation marked by the dashed lines. And what you can see is we think this is a good example because the two states had almost the same composition of banking, local versus not. They remained that way for the first few years. It trended downward. And then when Illinois first had interstate deregulation, then you can see that their kind of local banking index diverged and dropped, which meant that there was more activity, cross-state activity. There's not as much community banking. Dropped again when they passed the second deregulation. So now there is a pretty large gap between Arkansas and Illinois as far as kind of the composition of banking activity in the state, whether it's community banks versus more national banks. And then only started to converge together, back together again, when Arkansas also passed these laws. And in fact, towards the end of the time period, after both states passed these deregulation laws, Arkansas had kind of less local banking in that state than Illinois did. So it's exactly kind of these changes or these shocks into the composition of banking due to this regulation that's kind of shown in the trends of these lines that we want to leverage in kind of a more systematic way. We do that using something called instrumental variables regression. I think I'm going to skip over this, but the key thing to take away is that the regression has a very strong predictive power, which is something that economists and others that use these types of models are worried about, which is to say that these regulatory variables have a lot of explanatory power as to the composition of banking in the counties at a moment in time. I think what I'll do is I will end with this slide. And that way I'll kind of stay within the 40 minutes that were allocated to me and will be time for questions. So let me explain what this slide says. So this is the output of our event study model. We're looking at log wages, so you can think of it as a percent change in wages. On the x-axis, we're plotting what we're calling event time. So time before and after a natural disaster hit your county. And the red dots are the point estimates from our model, and the blue space is the 95% confidence interval to represent the imprecision of these point estimates. This is a model that's using the instrumented or predicted local banking index at the year before the disaster. So we're kind of solving this endogeneity problem. And because we're using this predicted index, which is also a continuous variable, we have to be a little bit careful how we interpret this. So I provide an interpretation here on the bottom. So what it means, or what this is showing us in these preliminary results, is that counties with a larger share of local banking in the year before a large natural disaster exhibit higher wages following the disaster. So I'll move from approximately the 25th percentile to the 75th percentile. That is moving from a county that is relatively has relatively low community banking to one that has relatively high community banking, implies about 0.5% increase in average county wages each year for the first 8 or so, or I guess 6 to 7 years following the disaster. As a point of reference, we also estimate a model that just doesn't try to leverage the county banking index, but instead just looks at, on average, documents what happens to wages afterwards. And on average, it's about a 4% increase in wages following a disaster. It's a little bit surprising. You might think that the wages would go down following a disaster, but on average, across all disasters in the United States at the county level, this actually leads to a little bit of a kind of a growth in wages, perhaps due to a lot of economic activity having to repair the institutions and so forth. And so what we're seeing is the composition, this move from the 25th to the 75th percentile of local banking can explain about 10% of the change in wages following a disaster. So it's not, it's probably not it's definitely not the only explanatory reason. It's probably not the largest one, but it does have a kind of a modest and an important role to play, we think, in these preliminary results of explaining what's happening to the economy following one of these shocks. So I think I might just kind of throw up my conclusion slide here, and I'll thank everyone for showing up and listening to the talk. And I want to kind of stop. So if there's any questions or comments, there'll be plenty of time for that. So I'll turn it over to everyone else.
Thank you, Justin, for such an interesting presentation. Like Justin said, please bring any questions to our attention now. You can use the chat function, the raise hand function, or it's a small enough group that I think you could go ahead and just unmute yourself.
Hi, Justin, that was really interesting and just not my field, so really appreciated the information. And I had two questions. One is sort of what's the role of insurance in all of this? Because it seems like insurance steps up and helps people recover from these disasters as much as getting loans from banks. Or am I not understanding that? And then I was just curious, we've had so many really expensive large disasters since your data set, the one you isolated for study, but also since 2014 where some of your data were. And I just wondered how you thought it was going to play out now with these, really large fires, floods, hurricanes, etc.
Yeah, thank you for the comments. Yeah, so I guess I'll start with the insurance one. So for sure, insurance is one of the important sort of safeguards or financial mechanisms that can help individuals recover or businesses recover and weather these types of events. I've done some work looking at flood insurance, for example, that in this context, you could also think about like homeowners insurance or maybe other types of insurance. So for sure that's going on in the background and is part of the picture. What we're trying to do with this study is kind of keep that as sort of the level playing field of what insurance might be out there. Although it could be something that we might want to just kind of dig into to make sure that might not be somehow confounding our result. But at this point, what we're thinking is we want to kind of allow for whatever's happening in the insurance markets to be there and really try to find like a window or a way into isolating one particular factor in what's going on, which is potentially the importance of providing credit that's not coming from insurance companies or existing insurance policies to individuals in these counties following disasters, and see if there's this important role to play, or maybe a more important role than's been currently understood, based on the kind of the type of lender, whether it's more of a community-focused bank or more of a sort of a geographically national bank. And so we're trying to make progress on that. But again, it's not to say that the insurance, isn't important or isn't a kind of a big piece of this puzzle. And then the reason why we're stopping at 2014, it's really more of a data-driven reason, because we're trying to get at this local versus non-local banking aspect. We want to leverage this kind of deregulation, and the deregulation happened in the 80s and into the 90s. And the farther we get away from that kind of deregulatory period, the less sure we are that we can kind of leverage that to help identify our model. Which is why we're actually, in today's talk, we're stopping at 2000. So we're not even going into the 2000s at all. But totally agree, if anything, these disasters are becoming more costly and more frequent. So that's part of our motivation in looking at it, that we think that it's only going to become a more important and consequential event as we go forward.
It also strikes me that, at least in the West, I mean, the wildland urban interface has grown, and often those are where people that do have a lot of insurance and do have a lot of wealth live and are affected by these disasters. So it seems like over time, just the ownership of land is going to affect your results. I don't know. What do you think?
I think it's possible, and you know, I think what you're highlighting is that you know, and we don't. I guess so. One way to think about it is if the period that we're looking at is in this study today is 1982 to 2000. So we might be able to hopefully get a pretty good estimate or understanding of what's going on average during this period. But it doesn't mean that that's going to be the same even in the next period, as you've highlighted. If say the geography of where people settle or where they build or where they live, if that changes, it could change kind of the underlying resiliency of these communities to these events. You know, maybe either direction. More wealth could be destroyed, or maybe if it's more wealthy individuals, they would have kind of more of a safeguard in place against kind of the worst things from happening. So it could kind of go either way. But I think that's super interesting to think about.
Colleen Moore asks, so what about credit unions, just to throw a wrench into your data collection?
Yes, so I'd have to go back and check the HMDA data, and maybe this is motivating Colleen's question. The HMDA data covers something like 99 point something % of all lending in the US, with a couple of exceptions. And it's possible that some credit unions are the ones that are more likely not to be covered by the data that we have access to. But we were still, and so we might think of credit unions as kind of the prototypical example of kind of a community bank. So they would, you know, potentially influence our measure of our local banking measure, you know, one way or the other if we're not properly accounting for them. That's something I'd have to go back and double check to see, you know, how much that might shift our measure, which could then maybe influence our results. But I would, I guess, conjecture that the community or the lenders that Colleen's talking about is probably going to line up pretty closely with what we're describing as like the community banks.
Does anyone else have any questions?
Hey, Justin, this is Dan. I've got a question for you.
Hey, Dan.
Hey, so you mentioned collateral kind of at the start of the presentation. I guess I'm just wondering, you know, if you have any information on the extent to which local banks, as opposed to larger banks, are more likely to practice collateral-based lending. And then also, you know, along that same line, there are a lot of states in the West, like Montana, for instance, that have non-disclosure rules. So it's not clear to me that lenders really, especially national lenders going to these areas, would really have information on property prices in Montana, because they're just not, you know, not disclosable to the general public.
Yeah, that's true. So on the second point, that's a great point. To my knowledge, I think Montana might be the only state that has like pretty severe restrictions on disclosing, say, property values to the public. What I guess one that might be less important, because here what we're thinking about in terms of collateral isn't so much like maybe it's like a hot housing market or not a hot housing market, but rather if your home is damaged, then you know, in the extreme case, if it's totally destroyed, then you're not going to really have that collateral value of the intact home to use. And so in the types of models that in the literature, and this is kind of maybe going a little bit into the weeds, but there's this literature, let me just go back to some of the slides that I skipped. So these guys, these theorists, Holmstrom and Tirole, really focus and make a distinction between sort of bank capital, that is kind of the resources the bank have to lend, and then capital held by borrowers in the form of collateral. And the reason they make that distinction, and again, this is going a bit into the weeds for maybe some in the audience, but their angle, their theoretical angle, is thinking about the moral hazard problem, and the moral meaning that they're going to be more worried about lending to borrowers that don't have as much collateral. And I guess it kind of loops back to your first comment, which is how sensitive are lenders going to be to the amount of collateral? And maybe that sensitivity is different between, say, more national lenders and more community banks. And I think my read of the literature is that that's true, that one of the reasons why there's kind of this literature on quote unquote soft information that community banks use, so they don't rely as much on, say, your income statement or your credit score or the value of your home, that just on the fact that maybe they've lent to generations of people in your family, or they have a good business relationship with maybe your business, or your family, or your kids go to the same church or something like that. So like all this type of stuff would fall into kind of like a more wholesome or collective kind of assessment, rather than just focusing on the collateral value.
Right. Yeah, that's the point exactly. And I guess I would just push back on what you said about Montana being the only non-discllosure state. I think
Yeah, so maybe I might be mistaken there.
it's
think,
pretty.
oh, go ahead.
I'd be interested to see what you come up with the repeat sales index once you get that together, because I've worked with farmland value data from CoreLogic, and there are probably 12 states where you just get basically nothing.
Oh, interesting. Okay, yeah. So we're in the early stages of putting that together. So I'll have a better answer for you once we have that.
Okay.
Do we have any more questions? Okay, well, it looks like we might end a little bit early, but that's all right. Thank you so much, Justin, for your presentation. It was extremely interesting. And thank you all for attending the Rough Cut today. Have a great rest of your Wednesday.